In the last 48 hours, Italy sold a brand new 15-year government bond, and foreign investors took about 84% of it. The deal size was 14 billion euros, and the order book hit roughly 157 billion. That mismatch is the whole story. By the end of this video, you will be able to track 3 simple markers that tell you whether this is real demand or just a one-day squeeze. Here is the clean setup. Italy issued a new benchmark BTP that matures in October 2041. It came with a 3.95% coupon, and it priced around a 3.99% yield. The Treasury used a syndication, not a regular auction. That matters because syndications are designed to lock in size fast, with a hand-picked bank group building demand. Now, take the first receipt. Foreign accounts bought 83.7% of the deal. That is not a vibe. That is a line item in the allocation data. I want to use one anchor example through this whole story. Meet Elena. She runs the bond book at an Italian insurance company. Her problem is simple. She has long-dated liabilities. She needs long-dated assets. A new 15-year benchmark gives her duration she can actually buy in size. In normal times, Elena is competing mostly with domestic banks and local real money. This week, she was competing with the rest of the world. So why did foreigners show up so aggressively? The mechanism is not mysterious. It is a 3-step chain. Step 1 is the yield pickup. Even after spreads have tightened, Italy still pays more than Germany for the same maturity. And the Italy-Germany 10-year spread has been hovering in the low double digits of basis points, roughly around the 60s this week. That is tight by crisis standards, but it is still a spread you can clip. Step 2 is the rate cut narrative. If the market thinks the ECB has room to ease over time, long yields have a ceiling. That makes duration look less scary. Foreign managers are willing to extend out the curve when they think policy is no longer pushing yields higher. Step 3 is liquidity. A new benchmark line is easier to trade, easier to finance in repo, and easier to hedge. That sounds technical, but in plain English it means this. If you have to sell, you can actually get out without taking a huge haircut. Now, a common misread is that a record order book means investors suddenly love Italy. That is not what an order book measures. An order book measures what people asked for before final allocations, while the banks are setting price. A lot of that demand is strategic. Funds over-order because they know they will get cut back. The more important question is, who ended up with the bonds? And here, the foreign share is the signal. But even that needs a second look, because foreign is a label, not a risk rating. Some of that is long-only real money. Some of it is fast money. Some of it is banks doing relative value. Here's the plain English translation. This was not just a good Italy day. This was a global hunt for yield in a world where safe bonds are not paying enough. Now, zoom out to the market reaction. Italian yields did not explode higher. Spreads did not blow out. Equities did not trade like a panic tape. That is the point. The market took in 14 billion euros of new long-duration supply and stayed calm. That calm matters for 2 reasons. First, it lowers Italy's funding stress in the near term. Second, it encourages more supply because the Treasury sees a window. But we have to be careful with the story people want to tell. Another common misread is, foreign demand means the refinancing wall is solved. It is not solved. Italy still has a very large debt stock that rolls over every year. One successful syndication changes the tone, not the math. Back to Elena, our insurer. When foreign money floods in, Elena gets a better price in the moment, but she also gets a new problem. If the marginal buyer is not domestic and sticky, the exit door can be smaller than it looks on entry. That brings us to the real risk frame. This deal is a vote of confidence, but it is also a concentration test. If global risk appetite shifts, the same accounts that bought can become the same accounts that sell. So, what flips that switch? Usually it is not an Italy headline. It is a global catalyst. In the next 24 to 72 hours, the market is watching 2 things. First is the path of ECB pricing, because it pins long-end rates. Second is any sudden move in Germany, because bonds are the anchor of the spread. Over the next 2 to 6 weeks, the focus shifts to supply and follow through. Italy still has regular auctions and more funding to do. If the next auction's tail or bid to cover falls, the story changes fast. Not because the country is bad, but because the marginal buyer is stepping back. And if this persists for months, the pressure point becomes the banking system's balance sheet. Banks hold a lot of sovereign paper. If yields rise, the mark-to-market hit tightens capital optics. That is where a bond story becomes a credit story. Now, the three markers I want you to track are simple. The first is the Italy-Germany 10-year spread. If it stays pinned near recent lows, it tells you the market is still comfortable with Italy risk. If it starts widening quickly, that is the first sign the marginal buyer is leaving. The lag is short, often same day. The second is the hedge pickup. Foreign investors care about what Italy yields after they hedge euros back into dollars, yen, or pounds. If FX hedge costs jump, the pickup can vanish even if Italian yields do not move. That can hit demand before you see it in the spread. The lag is usually days to a week. The third is auction tone. Watch the next Italy auctions for tails, bid to cover, and whether dealers are forced to take down size. A strong syndication followed by weak auctions is a classic tell. The lag is one auction cycle. Here is the calm urgency line. When you see 157 billion of demand for a 14 billion deal and 84% goes offshore, you are looking at a market that is confident today, but also one that can pivot fast if the global price of hedging or risk changes. Now, let's slow down and do the why now layer, because that is where the mechanism gets real. A syndicated BTP is not just Italy borrowing, it is a live check on how the world prices euro sovereign risk right now. And it is happening at the same time the ECB is publicly paying attention to the euro itself. That matters because the euro is not just a currency in this story. The euro is part of the funding and the hedge math. Here is the second receipt thread you can show on screen. ECB officials have signaled that a significant euro appreciation could trigger a response, and Lagarde confirmed FX was discussed at the meeting. That is not the ECB targeting FX, but it is them admitting it is a constraint. Plain English. If the euro strengthens quickly, imported inflation falls. That can pull inflation down faster than expected. And that changes the rate path. Why does that touch Italy? Because Italy's long end is a spread product sitting on top of Germany, sitting on top of ECB expectations. If the ECB gets more comfortable cutting later, Italy's carry looks safer. If the ECB has to stay tighter because inflation sticks, the long end can reprice higher and spreads can widen. So, one clean way to think about this BTP deal is this. Foreigners are not buying Italy only. They are buying Italy plus a view on ECB risk, euro risk, and global risk appetite. Now, bring Elena back in. Elena's insurer does not hedge euros into euros. She is naturally euro. Her demand is local and structural. That is the sticky bid everyone wants to see. Foreign demand is different. Foreign demand is often conditional. It depends on currency hedging, rate volatility, and what else looks attractive globally. Here is the part most people miss. A deal like this can look strongest right before it gets more fragile, because when spreads compress and demand looks effortless, leverage and positioning can creep in. That is why the buyer mix matters more than the headlines. So, what would fragile look like in the tape? It usually shows up as divergence. You get a day where Bund yields move up, but the BTP spread does not widen because buyers are still chasing carry. Then you get a second day where Bund yields are flat, but the spread widens anyway because the marginal buyer pulled back. That is not politics. That is positioning. Now, let's address one more common misread. People will say, Italy can always lean on the ECB. Yes and no. The ECB can stabilize markets through its tools, but it does not want to become a constant buyer of Italy risk. And the ECB's credibility depends on not looking like it is financing governments. So the better way to frame it is conditional. In stress, the ECB can cap extremes. In calm, the market still has to clear supply. Plain English, you cannot outsource demand forever. Now, what does what breaks first look like in this story? It is not the yield number on your screen. It is the funding and the bank loop. The first pressure point is repo and collateral terms. If a benchmark line becomes harder to finance, that changes who can hold it. That is a plumbing issue, but it matters. The second pressure point is bank risk appetite. Banks are big holders of BTPs. If yields rise and capital optics tighten, banks can reduce balance sheet usage. That can widen spreads even if the macro story has not changed. The third pressure point is global risk. If the dollar spikes, if volatility rises, if credit spreads widen, the first thing that happens is people cut spread products. Italy is a spread product. Now, let's turn this into an 18-minute video that holds attention without doom. You do it by making the viewer feel like they have a scoreboard. So here is the scoreboard in a tighter, repeatable way. Marker 1 is the BTP Bund spread. If it stays compressed through the next auction cycle, demand is still there. If it widens 2 or 3 sessions in a row without a clear shock, that is a sign the marginal buyer has stepped away. Marker 2 is the euro hedge cost. If hedge costs rise, foreign demand can disappear while local demand stays. That is how you can get a sudden drop in order books even if the domestic economy looks unchanged. Marker 3 is auction tone. If Italy's next auctions clear cleanly, with no ugly tails, the syndication was not a one-off. If auctions start to tail, or dealers take too much, spreads can widen fast because the market loses confidence in absorption. Now, the near-term catalysts. In the next 24 to 72 hours, the catalyst is ECB communication drift and any big Bund move. If Bund yields jump, spreads get stress-tested. If bunds rally, spreads can compress further and tempt more risk-taking. Over the next 2 to 6 weeks, the catalyst is supply. Italy's regular calendar matters more than any speech. Also watch rating commentary or fiscal headlines, but do not let that distract you from the market receipts. And if this persists beyond that, the catalyst is political plus macro. Not because politics always matters, but because it can change issuance plans and growth expectations. That is when spread markets start caring about trajectory, not just coupon. Now, I want to give you one last translation that keeps this grounded. A foreign bid at 84% does not mean Italy is safe. It means Italy was attractive at that price, with that hedge math, under that global risk regime. If the regime changes, the demand can change. So let's land this cleanly with the recap, the signals, and the realistic risk frame. What happened is simple, and the receipts are strong. Italy issued a new 15-year benchmark BTP maturing in October 2041. The deal was 14 billion euros. The coupon was 3.95% and pricing was about 3.99% yield. Demand was enormous, about 157 billion euros, and foreign investors bought about 83.7% of the allocation. Why it happened is also simple when you strip out the drama. Foreign buyers saw a yield pickup over Germany. They saw a rate path that feels less hostile than it did last year. And they saw a fresh benchmark line that is easier to trade, finance, and hedge. Plain English. This was the world reaching for yield in a product that still trades like Core Plus. Why it matters is where the story becomes a real market signal. If Italy can place long duration smoothly, spreads can stay compressed and Italy's near-term funding risk looks calmer. That can keep euro periphery risk contained. It also changes the tone across Europe's bank holdings and credit conditions. But it also creates a clean pressure point to watch. When foreign demand dominates, the market can pivot fast if hedging costs jump or if global risk turns. That is the trade-off. Strong today can mean more sensitive tomorrow. Now, the 3 signals to watch, repeated exactly. Signal 1 is the Italy-Germany 10-year spread. If it stays compressed through the next auction cycle, the market is still comfortable. If it widens for several sessions without a clear shock, the marginal buyer is stepping away. The lag is usually same day to a couple days. Signal 2 is FX hedging costs for non-euro buyers. If hedge costs rise, the yield pickup can vanish even if Italian yields are steady. That demand drop often shows up first in weaker order books, then in spreads. The lag is days to a week. Signal 3 is auction tone. Watch tails, bid to cover, and dealer takedown at Italy's next auctions. Strong syndication plus weak auctions is the classic warning sign. The lag is one auction cycle. Finally, the stakes ladder in plain terms. In the next 24 to 72 hours, the market tests whether spreads stay calm as bunds move and ECB communication evolves. Over the next 2 to 6 weeks, supply is the real test, because regular auctions show true demand without the syndication halo. And if this persists, the pressure shifts to the sovereign bank loop and the funding layer, where small spread moves can matter a lot for balance sheets. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.